Good evening, folks, and welcome to the Contrarian Trader. This is Robert Desmond. It is Sunday, November the 30th, 2008. Folks, I hope everybody had a great Thanksgiving. I did put on about 5 pounds, and I look forward to having another trading week with you. Before we get into what I think is going to happen this coming week, let's first revisit a couple of topics that I brought up on our last week ahead commentary on the 23rd of November. And at that time, I mentioned that all the signs were in place for us to enjoy a short covering rally in the stock market. Now, one of the questions I did receive was, Bob, how do you know it's going to be a short covering rally? What's short covering? How do you know the difference between short covering and new money, new institutional money coming into the market? That's pretty simple, and it comes down to volume. We had 5 sequential up days, and we had declining up volume throughout the week. Now, yes, I understand that it was a holiday shortened week. I understand that Friday was a half a day's trade, so I acknowledge that. But what I don't like to do ever is I do not like to rationalize volume. Either it's high volume, low volume, or average volume, and I make my trade decisions from there. So on Monday, if we see a spike in volume to above average levels, then you know what? Then my thesis is corrected somewhat, and we probably will see another couple of days of up trade here, which is entirely possible. So I'm not predicting that we're going to see Monday the market decline substantially. What I am predicting is that within the next few days, if we do see a couple of up days, that you're going to see those up days begin to stall, and you are going to see a setup for a declining move and a retest of the 741 level, which is not a bad thing. It's a good thing. So my recommendation to my subscribers to the Contrarian Trader, I sent out an alert letting them know that when we initiated our positions in the SSO, which is the S&P 500 Ultra ETF, the GLD, which is the gold fund, and the Goldman Sachs, is that we were going to use loose trailing stop loss orders because we didn't want to get shaken out of our positions, because the thugs on Wall Street, that's what they do. They see your order out there and they try to take you out of your position. Now that we have some very nice profits in those positions, we want to preserve those profits. So we're going to tighten up those stop loss orders because it's, again, our thesis that we are going to pull back, retest the 741 level, and hopefully hold that level and proceed higher. I have not changed my position. I'm still long-term bearish on this market, and that's because we've been in this position before, where back here at the 1007 level, I would have been saying the same thing to you back then. And believe me, I was telling my subscribers at that time to our newsletter, is that, listen, we're going to begin to peak out here. The up volume is declining, and we're going to retest 845. We need to watch and see if it's going to hold. As we know now from looking at the chart, it did not hold. Although it looked like it was going to, it did not hold. We failed, and that could happen again. So let's not take our eye off the ball. I think that we will hold the support level. It's my prediction that we will. But believe me, I'm not. There's not so much conviction that I have that I'll tell you that there's no doubt we're going to hold it. There's a probability that we could break and get lower. We're in a bear market, so let's not kid ourselves. Let's take a look at the financials, because as go the financials, so goes the S&P 500. And as you can see, the volume bars here again are all declining. We've been here before as well. The top of a trading range. Same here back at 1653. I was always telling my members back then, you need to have leadership in the financials to get us out of these doldrums. And we need to watch the financials. They need to hold 13. They did not. The moment that Goldman Sachs, the moment that the XLF broke 13, that's when you saw the sell-off in the market, and here we are today. So keep an eye on the financials. Keep an eye on IWM. The Russell 2000 volume is really disappointing. It was never really, with the exception of that key reversal day, was never really that great last week. And the Russell 2000 is a critical index. The Russell 2000, that index is an index of the the best and brightest next there's coming superstars in the stock market. Those are the next Microsofts, the Googles. You want to see those companies do well. You want to know that they have access to credit and they're doing well. The volume was not there last week. They were not being bought up even by institutions, even though they're deeply oversold. So that's a major concern. So keep an eye on the XLF, your financials. Keep an eye on IWM. Also, as a proxy, keep an eye on Goldman Sachs. Although JP Morgan and Bank of New York Mellon have better fundamentals, they do not have the influence of what Goldman Sachs does. So keep an eye on them. As I mentioned in last week's commentary, we went long of Goldman Sachs when nobody wanted it back at $52 a share. We currently sit with excuse me, a 51% profit in Goldman Sachs. And we are tightening up our trailing stop loss orders. We probably will get stopped out of it, and we'll look to get back into it. Hopefully, if we hold this 47.41 level, so we definitely want to preserve those profits. And let's take a look at the VIX, and this kind of supports my thesis on where we're going to go here. Where's my VIX? Here it is. Okay, on Friday, as you can see here, we had a key reversal on the VIX. We were lower. It reversed higher, and we gave up some of our gains on the day. What I'm predicting is that we will see a rally on the VIX, which means that the S&P 500 and the other indexes are going to pull back, hopefully retest. Hopefully the VIX won't break out. It'll show relative weakness, and the stock markets can then begin to rally back. And if the VIX, as I mentioned last week, breaks this 44.25 level, you're going to see a massive, massive rally in the stock market. No doubt about it. Let's get to the U.S. dollar, another key measure. Last week I mentioned we were sitting on the uptrend line. We had yet to break that uptrend line, but what we were seeing was a negative divergence, and which means the dollar was headed higher, yet the RSI, the momentum, was headed lower. That told us that the buying interest in the U.S. dollar was diminishing greatly, and that we should expect to see a collapse in the dollar, not a collapse, a correction in the dollar. Peter Schiff has me crazy sometimes, who's on YouTube as well. He's a very bright man. Peter Schiff is always predicting the collapse in the dollar. I'm hoping not. I really don't. Peter makes some great points. But as it stands right now, I agree with Peter that we are going to see continued weakness in the U.S. dollar. These two counter trend rally days here, no real great excitement for me. I think we're going to head lower here. I think we're going to break the 50-day moving average, and if we do break the 50-day moving average, let's begin to take a closer look at the USO. The USO had some strong bullish days here. This is the U.S. West Oil contract. Okay, let's take a look at the crude prices. This is the commodity itself, because the USO was sending me some bearish signals, not bearish, mixed signals last week on whether or not it was going to head higher. So for some clarification, I wanted to take a look at the commodity itself, and this is the WTIC, which is the continuous contract on oil, crude oil prices. And as you can see, on a weekly basis, we're at extreme oversold levels. We're poised for a rally in crude prices. The same could be said for natural gas. So sometime during this week, I'm going to be sending out alerts to my subscribers that let's get long, let's get bullish, the USO, and of natural gas possibly as well. Here are our stop loss levels. Natural gas. We have great upside potential with limited downside risk. Let's take a look at where's our downside. If we break the 2601 level, we get stopped out. We keep our stop loss just below that 2601 level, and the moment we break below it, we get out. It's automated. We do not sit there and watch a screen. We program it onto our computer, and we do not let emotion take advantage of us. We let the computer do our work. If it breaks below, say, a dime or so below the 2601 level, you're out. No questions asked. Look to get back in at a lower price. Same thing on the USO. Here's our low, 39.16. It's quite possible, looking at a monthly chart of the USO, that we could see 35.21 on the USO, which is the 200-month moving average. So, I'm bullish of oil, but I'm going to be cautious of oil as well. If we break below this 39.16 level, we're going to keep that loss small. We have tremendous amount of upside potential here. Let's keep that loss small. Live to play another day. And I hope to talk to you soon during the week. I'll put out another video during this week. And mail me your emails and questions. Post comments below. And have a great trading week, folks. Bye-bye.